Focusing on entry, exit, and stop loss alone will not make you a consistently profitable trader. There are many things you need to consider before jumping on to entry, exits, and stop loss. Want to know more? Keep watching. Hello, I am Dean, a full-time trader since 2005 and author of the book Anyone Can Learn Market Profile, and I help traders learn market profile, VSA, and order flow through my Dean Trading Framework. Dean Trading Framework will help you improve your market understanding, take better trading decisions in real-time markets, which results in reduced trading mistakes, and finally, an improvement in overall trading profitability. So if you want all this, don't forget to subscribe to my channel and ring the bell icon so that you don't miss anything. Let us get into the video. The most sought after words that beginner traders are looking for all the time, they are looking for an entry, exit, and stop loss to help them in their trading. And the reason why I'm worried is that these are not the things that are going to help you in your trading. Now, there are many reasons why this question is so popular, and the first is that mentors are supporting and publicizing it. And why so many people are sharing the same thing. What happens is, if you get a clear level, it gives you a sense of certainty. Whenever a beginner starts trading, he burns his hands for a while, he becomes afraid of the market, and then he finds someone who is giving him clear entry, exit, and stop loss levels. That is precisely the moment where he falls into the trap. The question here is, does it help you refine your art of trading? Tomorrow, if that mentor stops providing you calls, will you be able to trade the markets on your own? Thirdly, most beginners feel that trading should be easy. I don't know why the hell that particular thought is prevalent. Every other profession demands a minimum of 5 to 6 years of your life. Just take an example of becoming a brain surgeon. It takes more than a decade to become a brain surgeon. Forget about becoming a good brain surgeon. Beginners need to understand that this is not going to be easy. Is it impossible? Absolutely not. But it will take effort. It will take time. Why is entry, exit, and stop loss not going to help you? First and foremost, whenever you're going, somebody is giving you an entry, exit, and stop loss, they are predicting that, okay, market will go to this, from this level to this level, and you will make some profit. And if it comes down, then you are managing your risk by putting in a stop loss. That is what they are telling you, right? But how do they arrive at this conclusion? Most of them are giving you these calls based on some system, and 99% of those systems are based on past data. So they are analyzing past data and they are giving you these trade setups with precise entry, exit, and stop loss. Now, the problem with this particular thing is that markets are not certain environments. We don't know what is going to happen in the markets tomorrow, and then you also don't know how you are going to react to those developments. So it is very, very difficult to predict in any way what the markets are going to do. To create that authority behind whatever calls or tips are being provided to you by these mentors, they use the word called statistics. They say that we are using statistical techniques to predict what the market is going to do. We have done a ton of backtesting, and we'll come to backtesting in a minute, why it is also a big farce and you should not do it at all. First, you need to understand that there are two types of scenarios. First is known, unknown. Everybody of us have played Ludo or Snakes and Ladders and all those board games. We have a dice which has 6 numbers, 6 sides, a cube. There are 6 sides and 1 to 6 numbers are written on it. Say I'll roll the dice, you predict which number will come. Now, if you're rolling a single dice, you're not going to say 10, because you know there are 6 sides to the cube. Numbers 1 to 6 are written on those sides. So every time I roll a dice, any one of those 6 numbers has to come up at the top. So you know all the possible outcomes in that scenario. And since you know that, you can select any one of those numbers, and there is a 1 in 6 chance that that number will show up. This is an example of known, unknown. Known, you know that there are only 6 possibilities. Unknown is that you don't know which of that 6 possibility is going to play out. Now there is a 1 in 6 chance that you might be, let's say successful. And that is what statistics is made for. to help you analyze known unknown. But when it comes to market, you don't know which numbers are written on the 6 sides of that cube. If I don't show you the cube, I tell you that there are 6 numbers written, but they are not 1 to 6. It can be any number. I am not showing you what numbers are written on the cube. And I ask you, now I am going to roll the dice. You guess which number is going to come at the top. There are infinite number of possibilities, and there is just no method whatsoever which will help you predict that. It is same with the markets. Market is like a cube or a dice, the numbers on which we don't know what numbers are printed on that particular dice. So it is very, very difficult to predict which number is going to show up. These are unknown unknowns. You don't know what numbers are written on the side. You don't know which number will come up on the top. Statistics is not made for such scenarios. Backtesting. Whenever a system is brought to the market, one thing is invariably stated is that we have done extensive backtesting. We just looked at an example of dice. One dice has numbers 1 to 6 written on them. Another dice, we don't know what numbers are written on them. So when you are backtesting, you are essentially applying your rules and logics, whatever that system is, to a set of data or to the markets which have already happened. So you know the unknown. You know what markets have done in the past. And you are applying your logics and rules to that. You will be able to analyze something. You will get some results. You will get some data, some performance parameters that 70% of the time my system gives you 10% profit. And only 30% of the time it will blow your account. But now, when you take that system with all the backtesting, which is done on markets which you know have already happened, and then you start to apply it to real-time markets, it immediately shifts to the second scenario, that is unknown unknown. So a system which is designed for known unknowns, you pick it up and try to apply to unknown unknowns, it is not going to work. However beautiful that system is in backtesting, it is not going to work. It is used by the system designers and mentors and different people who are in the business of selling systems because they want to sell their system, because they want to build some credibility into their system. The system might be good for past data. It is not going to work in the future. So human psychology won't change, but it's not going to remain exact. And certainly not to the level that you can design a system based on past data and start applying it to future market developments and make money consistently. Just won't happen. So what is the solution? The solution is to find a system that matches with the current market scenario. How will you find out what the current market scenario is? Certainly not by looking at the past. You have to look at the present. You do it by improving market understanding. Market understanding has to come from your own efforts. I can give you means, but I cannot help you develop, a market understanding that is going to help you as a person and how you interact with the market. That is the hard work that you have to do. All I can do is point you in the right direction. The technical analysis methods that have, been publicized, or those that are easily available, like technical analysis of stock markets. If you put it in Google, certain number of videos will come up, certain number of search pages will come up. All those things that are coming up easily, they're not going to help. The problem is, those are the things most of the traders are looking for because they promise to make things easy for you. Especially beginners, when they're trying to search a solution for their problem, they really don't know what the problem is. They have no ability to judge whether the solution that is being given to you is actually the correct solution. What they do is they implement it, use it, and then after a while they realize that okay, this is not working, and then they jump onto the next system or mentor or method, whatever it is. So to improve your market understanding, you need to have underlying market philosophies that govern market behavior, which will help you understand how the market functions. Obviously there are a few, and those are really, really good at helping you understand why market does what it does. You'll have to first learn those things and then watch the markets and apply those things, implement those things, that thinking, that philosophy in the markets, and see whether it works or not. Now that you have good market understanding, it will be easy for you to apply or select rather the correct method or tool or system or whatever for the present market situation because you understand it. But if you don't understand it, how the hell are you going to select the correct method? Now, I am trying to bridge that gap. People are looking for methods, systems, entry, exit, and stop loss. I don't give them. What I give is a bridge between that lack of market understanding and market understanding. There are hundreds of people, hundreds of things you can use to take the next step. So people who will cross using that bridge can use any tool, method, and system and become a good, consistent trader and have a good, fulfilling career as a trader. A good place to start, obviously, is to use these four things. Now, why these four things? That has come from 16 years of market experience, losing money, blowing accounts, having strained relationships with family and friends. Because of all the financial pressures I had to face, I have learned it the hard way, and I do it because I don't want you to feel the same pain I had to go through. So after 16 years of painful progress in this field called trading, I have come up with these four philosophies that will help you in understanding the markets better. Are these my own philosophies? Absolutely not. I am not that great, but there are great people whose work you can use and become better as a trader. First, obviously, the person who has probably the most influence on all kinds of technical analysis is Richard Wyckoff. So you can start from Wyckoff market cycles and schematics. Then you come to the next dearest topic to my heart, that is auction market theory. That is brought to us by, auction theory is there from ages. It started when two people interacted with each other or transacted with each other for the first time. But Peter Stadelmeier is the person who applied that auction theory to market. So again, another great. He also gave us the 4 steps of market development. And then there is innovation adoption curve, brought to us by E.M. Rogers, who probably received a Nobel for that. So these are very, very potent philosophies which can help you understand the market in great detail. And then you will be able to select the method of your choice to apply to the current market situation. You will be able to judge whether that system is going to help or not. As I always say, most of the traders struggle because they are looking for the right answers. My point is, answers will come because market will answer each and every one of your questions by market development. The point is, can you ask the right questions in the market? Does your method help you ask the right questions? If all you are asking in the market is where can I buy, where can I sell, these are the worst questions to ask in the market because market will give you an answer. Why do retail traders struggle, you tell me? Because market will give them an answer. A retail trader goes to the market and asks where can I buy. Immediately market will give them an answer in the form of a setup, whatever mode market uses. Then the retail trader acts on that setup. And what happens? Majority of the time it fails, or it succeeds for a number of times. When the retail trader was just observing the markets, as soon as he puts in a trade, it fails. I am in favor of asking the right questions. Whatever I do, I try to help traders ask the right questions in the market, because market wants to give you an answer. All the smart money who are also trading with you in the markets, and majority of the time from the side opposite of what your trade is, they are there to provide those answers. Because you look at an answer, you will act on it, and that is where the smart money will trap you. Let us look at a simple example that happened on, I don't remember the date, I believe it was 13. It was the day when that big package was announced by our honorable Prime Minister. So what happens? You see prices moving up, then you get a pullback. Traders are waiting to buy the pullback because that's what they do. They are trend traders. They see a consolidation. They see a failed breakdown. Now they are very, very keen. They know that a breakdown failed. Market is definitely going to go up. What they do on the next day when the market opens higher, they buy this breakout. Why? Because that is the logical thing to do, right? That is the simplest way to make sense of all this information. 99 out of 100 mentors are suggesting go and buy. And what happens? Markets break out. They go higher for a while. Then they fall, close near the lows. Next day is a gap down. Then a sideways day. Then a big day down. Suddenly, all those who bought the breakout here, they are suffering. Their trade does not look good at all. Their stop losses have gone. If they did not respect their stop loss, maybe a margin call came in. Now, same market, same day. Let us look at it from a market profile perspective. All right, because that's my primary tool. Does not matter what tool you use, right? It's those 4 philosophies that we just saw. The 4 core philosophies that I have worked on in great detail, those are the ones that help me make decision. Now, how do I implement all those learnings in the market? I do it via market profile. So market profile is my choice tool that I use to implement my learnings and understanding from those core philosophies into the market. Let us look at that market profile chart. All right, so this is that day. All right, what happens? Simple. On the previous day, we go down, we spend a lot of time here. What I'm saying, a lot of time is spent here, a lot of volume is attached here. And then late in the day, we rally and close at the highs of the day, near the highs, because everybody is anticipating a big package. On the next day, the speech starts, package is announced, but see what happens with the market. Market open with a big gap. This is the open, this was the close, there is a big gap, does not even go much higher, immediately comes back down. That is all right. I mean, if market is gapping up, obviously some profit booking is going to happen. All the retail traders took it as a pullback. They started buying here when the prices came back down. You know that there are a lot of traders who are there from my membership. They are from my Telegram channel. They know that I said this looks to me like the smart money is selling. Now, even if you are following market profile, you know that if there is a B shape in the market, it tells us that there is a higher time frame buying in the market. But still I said that the smart money is selling. How do I know? I know it because I use those core philosophies. I look at the market development. I know what market is expected to do but is not doing. There are 100 things that go on in making a trading decision. It might look overwhelming at first, but it is not. Now, if the markets were strong, they had to break out above A period, that is the first period. Then they form initial balance in A and B, and they had to break out some more, continue the trend, give signs of good trade facilitation at higher levels. In simple words, when prices were going higher, new buyers had to come into the market. Did that happen? If that had happened, why would the price come down and trade near the low of the day? That is what made me think that maybe smart money is not buying here. Also, on the previous day, you see a lot of volume and price and time was spent at this level. Suddenly, because of the announcement, it goes higher. And then there is no follow through at all. Smart money is not taking any advantage. Buyers are not taking any advantage of this gap up. It tells me that something that happened here is not yet resolved. All the business in this zone is not yet finished. Some of you who are new to this particular topic may find it a little difficult to understand. But please, if you go and watch my other videos on market profile, these things will become easy. And I'm talking about free videos on my YouTube channel. So there was some unfinished business here. That is why we could not take advantage of higher opening. And immediately on the next day, we came back down and tested this level. So on one end, you are tracking a reference, let's say 9,500 or 400, whatever that top was, and prices go above that, and you are compelled to buy because you are buying a breakout. So your entry is buy a breakout. Then obviously you will put in a stop loss somewhere. If you have good amount of money, you will put a stop loss below this, or you will start thinking that if the gap closes, I will exit my position. So these are your stop loss levels. So at 9,400 or let's say 500, wherever the top was, this was your entry. And obviously you will have some idea that okay, this is the range which is say 8,800 to 9,500, some 700 points wide range. So if a breakout happens, it should go another 700 for whatever your rule for exit is, that is your exit. But what happened immediately the next day, your stop loss was hit. Instead, if you had focused on what the market is doing, what different traders and time frames are doing, where the value formed, where the time was spent, you will understand that this is not the way market was expected to behave. And if it is not behaving as expected, something is fishy. You should exit your positions. At least, maybe not take the opposite side, but you have to get out of your position. Those who did not get out, held on to their position, had to suffer this fall. That is how, market understanding will help you. If you have the right tools, if you have the right philosophies. I mean, tools you can use of your own choice. Market profile definitely is the best tool for the job. But you can do it with any chart that you track, until you are using the right philosophies and the right logic to understand the market. Now, How do we proceed from here? I have told you that okay, you need to understand, you need to select a strategy that matches current market situation. Great. How do I find what current market situation is? You have to learn some underlying philosophies and then implement into the market to improve your market understanding. Great. But still, how do I proceed? What do I have to do to be able to implement my understanding of those philosophies into the market? As I said, you need a logical foundation or a framework that gives you that power to understand the market. That comes from those four things: Wyckoff auction market theory, innovation adoption curve, and four-step market development process. If you nail that, you have the requisite power to understand the market. And then comes a process. Process is the most important thing. You have to follow a consistent process day in and day out to apply those learnings to the market. Tools used: market profile is good, VSA is good, order flow helps, but for that matter, any tool will do if you have that understanding and if you have the process and you use it day in and day out. So the next important thing is to have a process. Now, the process is not obviously a small one, and you won't be able to learn it in one day or 1 week or 1 month. You have to commit to it for longer durations, keep using it so that you become expert at it. So are you curious to learn more about this process? Then watch this video. If you like this video, give it a thumbs up, and if you don't like it, leave your suggestions in the comments below. Want to learn more? Consider subscribing to my membership. Links in the description below, and I'll see you in the next one.